So here's the big question. You're interested in value investing and valuing and evaluating businesses on a deep level, but you don't know how, even after researching for hours, probably dozens of hours, hundreds of hours on the internet, and because nobody else shows you how to do it. This podcast has all those answers and much more about value investing and finance. My name is Jason Rivera. Welcome to Value Investing in Your Car.
Hey, Jason here. Today's episode of Value Investing in Your Car, I'm going to continue telling you what I found when I did my research project, my stock research project last month, where I researched 3,943 companies in 40 days in 73 different countries. Today we're going to talk about the valuation of those companies and kind of what this means. Before we get to that, and to let you know that you can get this podcast anywhere in the world for free on all major podcasting platforms, iTunes, Stitcher, Spotify, SoundCloud, Anchor, and more. You can get this Value Investing in Your Car podcast anywhere in the world for free. Okay, so a couple weeks ago, I showed you my initial kind of look at the companies, at the companies and countries represented on my watch list. 108 companies total. Various different countries. And I said, based on a company or a country like Japan having, I think it's 22, 23 companies represented on my watch list, does that mean they're the best company or the best country to invest in now? And I said it depended on the valuation, which is what we get to today. Before we get to that, if you haven't watched the previous video, it will be linked below, where I go over the countries, the number of companies, stocks I found in each country, the percentages. And before we get to today's information, I also just want to do a quick recap and tell people how I got to this point. So last month and the month before, I've had 3,943 stocks manually, going one by one with their stock tickers. I did my visual preliminary analysis checklist, which 97% I think of the companies failed. And I did my full preliminary analysis checklist on 108 companies. What I'm doing in these set of videos is showing you what the data is telling me, because I don't want to rely on emotion when it comes to making potential investment decisions. So, having done that quick recap, again, if you want the full information, make sure to look at the video below. It'll be linked below this video. Okay, so the total, let's start here first. Total average EV to EBIT is 15.2 based on all 108 companies that I did my preliminary analysis checklist on. Again, I look for numbers below 8 on this. So that means, based on this metric, I've been saying for months now that stocks would have to fall another 30 to 50% for them to be kind of, in general, undervalued. It's even more than that. So this would mean the company's stocks worldwide would have to fall by about 40%, 45%, based on EV to EBIT, for me to consider the average stock in the world to be cheap. And remember, the stocks that are on my watch list that I did my full preliminary analysis checklist on are the best companies in the world, or at least the ones that have high margins, low debt, good free cash flow production, generally very good to overall great companies. And again, at least in terms of metrics and margins. And they're still overvalued. So that's part of the reason they're overvalued. This shows an even scarier picture, frankly, for valuation. The average for all 108 companies is EV to FCF of 28, which means stocks would have to fall, based on this metric, by about 60 to 70% to be considered cheap on my level, on average. Again, this is just the average. Couple of quick notes before I continue talking about the individual countries. These two numbers, the EV to EBIT and EV to free cash flow are after excluding one company that had a massive EV to EBIT of 152 and one that had an EV to free cash flow of 2,498. That is one of the highest overvalued companies I've ever seen, at least on a relative basis. Again, relative basis being the key word. I need to emphasize this before going forward. These are just relative valuations. I use these to kind of gauge where things may be undervalued or overvalued and see where I may look, but I look at the individual companies themselves. For example, when we talk in the US, on average, EV to EBIT is 11.1. Again, a decent amount over my 8 or under to be undervalued. But there's also a company in here that I found that has a 0.9 EV to EBIT, the lowest I've ever seen. Same company has an EV to free cash flow of something around 2. Again, the lowest I've ever seen. So these are just averages. So having said that, based on what we talked about last week combined, or a couple weeks ago, combined with this week and the release of this data, the most undervalued company on a relative basis is Austria, the UK, and the UAE. Does this mean that those are the best companies to invest or countries to invest in? Possibly not. The data here is light for some of these countries. For example, to take the average here, I had to have at least the country average, I had to have at least 3 stocks in there to consider it to be an average. So that's not very much data, frankly. Israel is also not in here. I had 3 companies, stocks from Israel on my watch list. That's not on here because one company in that had a negative free cash flow, EV to free cash flow. So I didn't include that in the data. The most overvalued, Sweden, Japan, which we talked about last week and I'll talk about again here shortly, France, and Brazil. Again, I look for anything under 8 to be considered undervalued. People in March, April, May, and as of this recording, we're towards the end of May, are saying, or at least people in the mainstream media are saying, let me preface that, we're saying that now is the perfect time to buy stocks because they are undervalued after the crash in March. They are not. Most of this data was from March and April, before the recent climb in April and May in the stock market. They were not. Now they're even less undervalued, on average. Again, on average. You can still find pockets of value. Again, I have a list of about 8 to 12 companies that look like potentially great investments that I'm doing research on currently that are massively undervalued. Some of the lowest valuations I've seen ever. That one company I told you about from the US, lowest relative valuations I've ever seen. So you can still find pockets of value, but in general, markets would have to fall based on my earlier talks, 30 to 50% to be considered cheap. By the actual data here, it's between about 40 and 65%. They would have to fall for me to be considered them cheap on average. Again, that likely will not happen. But this shows specifically right here, oops, there we go, that if somebody's telling you the stock market is undervalued or that stocks in general are undervalued, they are not. It's not even close to being undervalued. Not even close. At best, or kind of at worst, they're slightly overvalued. They're not even fairly valued on average. Slightly overvalued on average using this number. Massively overvalued using this number. So what does that mean? What do these two kind of in comparison mean to each other? This being 15, this being 28, means that companies on average make a lot less free cash flow than they make operating profit, which of course makes sense because operating profit is before free cash flow when you kind of calculate them out. Free cash flow is the very last line, usually. The very last line of this is what's left over for the company after taxes, after all their expenses. That makes sense. What this also means is that companies are going to be in trouble. Again, like I've been saying for months now. Companies are going to be in trouble because if they don't have free cash flow, they cannot keep operating. And you're starting to see this. I've been saying this since March. You're going to see massive bankruptcies, which is going to lead to companies closing potentially for good, companies having to restructure, and more unemployment. This is already starting to happen. In the last month, we've seen Virgin Atlantic, I think, the Richard Branson airplane company, filed for bankruptcy. Neiman Marcus, JCPenney's, Diamond Offshore Drilling, I think is what their name is, Occidental Petroleum. The list is building, and these are just a few of the companies that have filed for bankruptcy because they don't have enough free cash flow. It's going to keep coming, and this proves that out even more because companies do not have as much cash flow. Again, this is the final number after everything. This is before things like taxes. This EBIT. It's before things like taxes and what else is operating profit before? R&D maybe as well. I can't think of it off the top of my head. But I think R&D as well. This is scary stuff. Not in terms of just the valuation. That's scary enough because there's essentially what these numbers are saying right now is there's no margin of safety, which means there's higher risk. We as value investors look to mitigate risk as much as possible, and we do that by buying undervalued assets. It's been almost impossible over most of the last 5-6 years, and it's still very, very, very hard. Again, which raises the risk level for everybody involved. So I hope you found this interesting. Again, these are averages. I need to illustrate that you can still find pockets of value. If you're finding pockets of value, I've got a poll up on Value Investing Journey Facebook page right now. And the poll question was, are you finding a bunch of stocks to evaluate now? Are they cheap? Do you find stocks to be cheap right now is what that really means. 50% is saying yes, 50% is saying no. So you can still find pockets of value depending on where you look. But in general, there are certain countries that are massively overvalued. There are certain countries that are kind of fairly valued to slightly overvalued. But in general, companies are massively overvalued right now, still. So if you're like me and you're looking, it sucks for us. But until that happens, keep looking. And again, you can find pockets of value. You can find individual companies on occasion, but you have to search through a ton of companies. I searched through 3,943 companies in 73 countries, found 8 to 15 that look like they may be potentially good investments based on metrics and early relative valuations. This doesn't even include me reading financial reports, 10Ks, annuals, proxies, quarterly reports. I'm not even to that stage yet on some of those companies. So I'd love to hear your thoughts on this. If you're finding value, I'd love to hear where. If you are not finding value, I feel your pain. And because I'm in that camp. But I'd love to know where you're looking. I've looked all over the world. I'd love to know where you're looking and see what your thoughts are. Thanks for watching. And if you're watching on YouTube, make sure to like, love, share, subscribe, comment, and hit the notification bell so you're notified anytime we release a new video. Make sure to check out the valueinvestingjourney.com website to get a ton of value investing and investing education for free. And make sure, again, to like, love, share, subscribe this on the podcast as well, the Value Investing in Car podcast. And make sure, I would really appreciate a review on there. That's how we get seen by more people, and more people we can help. So we'd love to for you to give us a review as well. So thanks for watching. Have a great day. Talk soon. Bye.